Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing, and today we'll be going through the chapter 14, and we are talking something new in this chapter, which is bond funds. And to our surprise, once again, here also the relentless rule of humble arithmetic also prevail. Let's just look into the chapter. So Bogle is beginning with some introduction about the bond. Where he says that while a seemingly infinite number of factors influences the stock market and the each individual stock that is traded there, but there is just one single factor that dominates the returns earned by the investor on the bond market, which is the prevailing level of interest rate. So interest rate is the only factor in the bond market. So that means predicting the returns through the bond markets pretty easy if you can correlate them with the interest rate, and they have a very strong correlation. But we talk about the stock market and the equity funds, there are so many factors, and there it will be really difficult to predict the outcome. And the bond managers also cannot do much to influence the interest rate, because that's something the corresponding federal bank, or in case of India it will be SEBI, which is going RBI, sorry, it's going to be controlling the interest rate, and the bond manager don't have much of the control there. So definitely, if you know what is the current prevailing interest rate, and if you can guess where the interest rate going to be, then you will be able to predict your bond returns accordingly. So this is a simple correlation being mentioned about the interest rate and the bond yield and the price impact. So on the left hand side, if you see, as and when the interest rates are growing, your bond prices are going to go down. Similarly, if the interest rates are going down, your bond prices are going to go up. So that's a direct correlation. Similarly, if you look at the yields of the bond, then as soon then if the price of the bond falls, then your yield are going to rise, and if your yields are going to fall, then your price are going to go rise. So that's the way. So overall, you can say that if the interest rates are going to go down, you are going to make better returns in your bonds. That's a general assumption you can take. Uh, so, what should an intelligent investor? Now, the question comes is that why should an intelligent investor hold the bonds? Uh, so, first of all, the Bogle is beginning with three important points for us to convince that we should be holding the bond funds. So, first point is that over when we invest for a very long duration, so the long duration is always consisting of a series of short durations, and in these series of short duration, there are some duration which gives high return, and there are some duration which gives lower return. And the same thing applies even not only in the stock market or in the equity funds, it also applies on the bond funds. There are certain periods where bond has given better return than the equity funds. So we are simply trying to capture some of those short periods. And second thing is that, and which is as per Bogle is the more important, that is reducing the volatility of your portfolio and provide the downside protections against the large market decline. So that is very important, because volatility is something, as per Warren Buffett, we should be making volatility as our friend if we want to really make good profit in the stock market. But unfortunately for the retail investor, volatility is their biggest enemy. So retail investor is not able to make the or utilize the volatility out of the stock market to gain the uh, good market returns. So having some bonds in your portfolio is going to reduce that volatility, and it provides some downside protection. But why do we need downside protection? So for that, the third point which Bogle says is that the conservative nature of a balanced stock and bond portfolio can reduce the possibility of counterproductive investor behavior. So that's something we have understand. This behavior is the major key which is going to uh, make sure that your stock market investors or retail investors are not making good return because of their incorrect behavior. And this behavior is as termed as counterproductive investor behavior. Because when the markets are running, they are going to put all their money. And when the markets are falling, that's the time where they should be putting more money, but instead of doing that thing, they are trying to withdraw whatever they have invested. So that's the counterproductive behavior, and that's the main reason that they are not even able to earn for whatever the even the mutual funds are making for them. Their returns, the retail investor returns, are much lower than the fund returns. So this counterproductive investor behavior can be stopped if you have a good portion of the bond as per as your investor appetite. So definitely now the question becomes that why should I own the bond fund? No, this is not the right question. The right question is that what portion of my portfolio should be allocated to the bond? So that should be the right question. So we should be judging our risk return capacities. We should be judging our behavior, and based on that, we should be taking a proper allocation of the bond in our portfolios. That's the way to go. So bond market now Bogle talks about the bond fund managers which are tracking the bond market. So here also the same thing applies, similar to this stock market, with as the group of the managers in the bond markets are eventually going to deliver whatever the baseline returns are given depending on the current interest rate environment. So there are few managers which can do better for a while or for a long duration. The reason can be they can be extra smart, they can be little lucky, or they might be taking some extra risk. And to differentiate between the all the three things, it will be really difficult for a real investor. Uh, and the risk of another point which Bogle mentioned is that any bad decision that we make in these bond funds, they can really impair our long-term returns. So it's normally it's an assumption that the bond markets are safe and equity markets are having risk, but that's not always true. In fact, sometimes some of the bond funds are having higher risk compared to the equity. That's something a retail investor should be doing. Then Bogle further continues and says that even if bond manager adds a fraction of 1% to a fund gross return, then they rarely overcome then all those so whatever, let's say 0.25 or zero point 0.5 extra return they have generated by being extra smart, lucky, or taking some extra risk, but then these whatever extra they have earned, that is getting overcome by the fund expenses, fees, and the sales load. So overall we can see that they are just reaching to a break even point. So for a bond fund manager, it's really difficult them to beat the index again. Uh, Now Bogle talks about two major risks in the bonds. So first of all, first one is that bond manager can take some extra risk by extending the maturity of the bond. In general, it has been mentioned that the longer term bonds has the higher risk, and because of the higher risk, their yields are also higher. So sometimes bond manager can take an extra risk by extending the maturity of the bonds. And the second way to take the risk is that bond managers tempted to increase the returns by reducing the investment qualities. In general, we have AAA grades or the which we call as the investable grade, or the government securities. But then if you are investing in a very low grade, let's say A minus or B, C, even we have to D. So there definitely you are increasing your lot of risk because you are getting the higher yields, but at the same time you have the risk that your capital might not return. So those are the two major ways where a bond manager can take some little extra risk just to get you a little higher return. But we should be understanding that if your bond manager is taking that risk, then definitely any bad decision of his can make sure that you even lose the principal in your debt bond funds. So we should be really careful about these risks. Now, there can be many categories in the bonds also, unfortunately, for the uh, uh, retail investors. The haystack is increasing large and large. But in general, as per Bogle, he simply categorized them into three broad categories. So first one is the short term. where portfolio, and these are designed for investors who are willing to sacrifice the yield to reduce the volatility. So definitely your returns will be slightly less, but then volatility will be also be less because they will be having least impact on the interest rate fluctuation. Then you have the long-term one, where you have the maximized yield, but then you are prepared to deal with the higher volatility. Why? Because long-term bonds are having high sensitivity towards the interest rate fluctuations. And then you have somewhere the mid-term bonds, mid duration bonds, which is simply a balance between the income opportunity and the market volatility. So it's depending on what kind of investor you are, you will be able to select any of these funds. In general, if you take my personal advice, I would prefer to go for a short-term bond because I am using my bond to uh, make sure that my portfolio is providing a good downside protection, and I'm not here to earn good return from the bond market. I am here to uh, I use equity as a medium for me to earn good return, and I use bond fund just to give protection to my portfolio for the downside protection. So now I'm leaving up to the investors, up to you to decide which one is suitable as per your temperament, and accordingly you can invest. Uh, Now Bogle clearly says that like stock market, actively managed bond fund lags their benchmarks. And now the question comes, why? The arithmetics of cost. And we have really heard the statement is that remember, O stranger, arithmetic is the first of the sciences and the mother of safety. So we should not be making any guess that this fund manager or that fund manager is going to beat. We really need to understand the science, that why, how a bond manager beats an index, what extra risk he is taking, and what are the costs. Then based on the risk and cost, whatever extra uh, is it really, is he going to really make that thing? As per data, it really very difficult for a bond market manager to beat the indexes because of these costs. So costs are the one that we should be saving if we want to become a real wise investor. So here Bogle has given some data mainly for the two categories. One is for the uh, US government bonds, another is the corporate bonds, which we call as the investable grade bonds. And so he done that with all the three categories, broad category, short term, the intermediate, and the long term. So we can clearly see the data. So on an average, 81 to 88% of bonds are not able to beat their corresponding benchmark indexes. Once again, a clear winner. So indexing not only works in equity, indexing is also working in the bond market. We have taken a 15-year of data, and this data clearly says that once again index are making the benefit. Unfortunately, the equity, the how the equity indexes are getting more familiarity, the bond index are not very familiar. When I was looking for some uh, good active, good index bonds, unfortunately, I don't find much of them available in India. There are very few available, and that are only restricted to the PSU related bonds. So now definitely comes that what is the value and why the bond index funds provide a good value. And here Bogle says the reality is that the value of the bond index fund is derived from the same forces that create value in the stock index fund. And those are the broad diversification, the rock bottom cost, the disciplined portfolio activity, tax efficiency, and focus on shareholders. So same logic. So these are the main points on which we can say not only the stock index fund, in fact, that debt index fund is also going to provide you a good value. And definitely the here the focus is on the shareholders, not on the mutual fund companies or the mutual fund manager. So this is, as per Bogle, this is the common sense characteristic that enable index fund to guarantee that you will earn your fair share of return in the stock and the bond market. And that's what he's explaining in each of the chapter, that if you really want to earn your fair share, then index investing is the way to go. And now he is saying not only for the stock market or equity, it is same logic applies even in bond market also. So here is Mr. Peter Fisher, who was a prior head of fixed income in BlackRock. He really clearly says this thing that we are moving in the second phase of index revolution. So our first phase was equity, and the second phase is now for debt. The world is frightening, uncertain place, and investors want to make their bond portfolio much simpler so they can sleep at night. We already know that equity investing is causing people to left over their sleep because they are not simplifying their portfolio. Now, similar thing can happen with your bond portfolio also if you are making your bond portfolio also complex. So better to go for an index fund and try to avoid any such fluctuation in your bond portfolio in order to have a better sleep. We are trying to do this passive investing through index fund so that we can really control our behavior. But if we are not following that thing, then our counterproductive behavior can really destroy our journey towards getting the good return from our investment. Uh, then there is another book, Index Your Way to Investment Success. Uh, So where Mr. Walter is again giving some very good data, and he says that the data provide a sobering glimpse of the challenges encountered by the active bond fund manager and suggest how much additional return active management may have to add on average over an extended period just to break even. So you see, these bond fund managers need to put really lot of effort just to break even to their corresponding indexes. So that clearly shows that if you have an option to invest in an index bond fund, then go for it. Don't go for it. Don't look for searching for a bond mutual fund which is going to beat the corresponding index. That's again a loser's game, and don't play those losers game. That's the advice Mr. Walter is giving here in his book. Then Mr. Tim Hill, in his Smarter Investing, he is also giving some similar data to us, and he says that you should not look for efficacy of index investing for bonds, which up to now has been whispered rather than shouted from the rooftop. So clearly, he is mentioning that the index investing in bonds is right now not getting a lot of attraction, but it works. That what Bogle has already convinced us in this chapter. And the evidence is compelling and comes down firmly in favor of investing in index fund. So Mr. Tim is also agreeing with Mr. John Bogle. Over the 10-year periods between 10-year period, the bond index fund returns are more compared to the actively managed bond funds. And we can see a difference of between 0.7%. So index funds are beating 85 percentage of all active funds in the bonds category. That we already seen with the data between 81% to 88%. So that's pretty a good number. So, and why is that? Why they are not able to beat? That's because the differential is largely due to the fees, and that is what Bogle is terming as the humble rule of arithmetic. So your 2 plus 2 is going to be 4. It cannot be 2 plus 2 cannot be 5. That's the arithmetic rule we have to be taking, and that's the mother of safety. So I hope by now you are convinced that why somebody should be using the bond fund in in their portfolio. And if you have decided to go for the bond funds, then you should be deciding what percentage of bond funds you will be having on your portfolio. Once you decide on that percentage, you will be selecting a category. Uh, Depending on your appetite, do you want to go for a short term, intermediate, or a long term? And once you have decided that thing, then go for the index fund if it is available in that category, because that's the way of investing. And because we understand that the relentless rule of arithmetics is also working not only for the equity, it also works for the bond fund. So I hope now you are pretty clear, my viewers are pretty clear with the bond fund investing. So thank you once again. I hope you make something out of this thing. This was a completely a new topic. I think till this point we were talking about the equity only. Now we have diverted a little bit, and now Bogle is introducing about the bond investing also, which is also important to avoid the counterproductive behavior. If you think this kind of a videos are really making, and especially to those people who find it difficult to regularly read uh, books, and I think if you go through some sort of an audio-visual presentation, then things are really easy to understand. If you really think that we are making some value in your life, then feel free to like, share, and subscribe to these kind of content so that they can reach to more of the retail investors, and we can uh, we can stop their counterproductive behavior and make them good, wiseful retail investors. So I'll meet with you again with the next chapter very soon. Till then, thank you and Hare Krishna.